Hello everyone, welcome to another episode of In Conversation by Advisorkhoj. Today in conversation, our guest is a very dear friend of mine and my ex-colleague, Mr. Anupam Tiwari, Head of Equity with Groww Mutual Fund. Welcome Anupam to In Conversation with Advisorkhoj today.
Hi Suren, great to be with you again.
My pleasure. So Anupam, just for our viewers, could you just take us through your background, your experience about your investment management journey and your experiences so far?
Okay, so I have roughly around 20-year experience formally in mutual fund industry, but as an investor, etc., I have now completed close to 25 years. Bought my first stock in 1999, and then started my journey. Joined Reliance Mutual Fund way back in 2005. Then moved to Principal as a fund manager. Then went to Access as a fund manager, and now I'm here since last 1 year as head of equity.
Wonderful. So, Anupam, Groww Mutual Fund are launching their Groww Multi-Cap Fund, NFO, on the 26th November and closing on 10th December.
Yes.
Right. So, of course, as you know, multi-cap as a product category is quite crowded already. So, if you could just take our viewers in terms of how will be your investment strategy for the multi-cap fund, number one. Number two, the 25%, the balance. How do you plan to deploy that? Will it be more momentum or a growth oriented? And why did you choose a multi-cap fund at this point of time?
Okay, so let's take the questions in the inverse order.
Absolutely.
Why to choose it this point of time? I think timing the market is less important. Time in the market is more important.
Absolutely.
And what we believe is that next 8 to 10 years, if you are in the market, mid and small caps are going to give you good returns. I think better than large caps. And that's the reason why we are doing a multi-cap strategy. Because it's a very disciplined strategy for allocation towards mid and small cap. So for a lot of people, small cap and mid cap allocation becomes a problem. Or let's say normal investor, right? Because they think that mid and small caps are more risky, etc. So a multi-cap approach makes sense. It becomes like, in my opinion, it is the most appropriate product for an investor because it gives you a disciplined exposure to all the segments of the market. And we know that opportunities are across the board, right? So that's one thing. Coming to your second question on how the remaining last 25% discretionary part will happen. So I think we want to remain completely flexible on that part, depending on the context of the market situation and availability of stocks at right valuation. We will take a call that which side of the market, whether large cap, mid cap, or small cap, we want to be. If you asked me like 2 months ago, I would have said more large cap, but now I think it could be more mid and small cap.
Yeah.
After the fall, and we will get money after 16th of December. So post that, we will have 1 month of time to create the portfolio. So I think by that time, things might change a bit more in favor of mid and small caps.
Sure.
Coming to your first question, how we are going to be different. Right? So per se, now the product nomenclature is such that in the allocation part, minimum allocation part, you cannot be different. So the one difference would be on the discretionary part, that is the remaining 25%, where I think we will be very flexible and we will be very opportunistic in terms of allocating money. So it will not be very static. That's one differentiation. Generally, what we have seen is that allocation tend to be more static in nature, even the remaining 25%. The second part is that our overall theory in terms of how we want to manage the money is basically what we call is QGAR, quality and growth at reasonable price. And that is what you asked, whether you would be more growth oriented, momentum, etc. So we are actually nothing. We are trying to be like more in terms of finding opportunities to create wealth. So we are not harping on any particular one strategy. What we have decided as a fundamental rule for us is that we try to address the investment decision making on the first principle basis. So why you want to buy equity? You want to buy equity to compound. Right? Compounding is your ultimate objective of owning equity. In compounding, you want to have two things. You want consistent higher compounding, and you want the duration of compounding to be longer. Because that is how you keep on creating disproportionate amount of wealth for you, right? So we asked ourselves a question: what creates higher and durable compounding? And then we came up with three factors: quality, growth, and valuation, right? So now here you need to understand that when as an investor we want to compound higher and longer, the compounding has to happen at two levels. One, the business that we own has to compound. Number two, our portfolio should also compound. Sometimes what happens is that business is compounding, but your portfolio, because price is not compounding.
Absolutely true.
And that is where the valuation factor becomes very, very important. So for example, there might be a very good bank. He has, let's say, ROE of 13, 14, 15%. The business is always compounding at that rate, right? But the price will not be compounding at 14, 15%. And we own the stock, we don't own the business per se directly. So our portfolio should also compound. And that is where valuation becomes the most important factor in ensuring that the portfolio is also compounding along with the business.
Sure.
So the first two factors are important for the longevity and the rate of compounding. So quality we look at from two perspectives. One is that we look at the corporate governance standard of the promoter or the management, because that ensures your duration of compounding. In short term, it may not necessarily be impacting the rate of growth of business, because in a good cycle, generally, even bad promoters' businesses do well. Right? So their stock may also do well. But when you are looking at 8, 10 to 15-year compounding, then this becomes very, very important factor in terms of quality. The second thing is quality of earnings. So we look at ROE. We are happy to own a high ROE, low growth business rather than a low ROE, very high growth business.
Sure.
For example, if a company is growing at 40, 50%, but with, let's say, very low ROE, 10, 12%, similarly, there is another business which is ROE of 20% and growing at 15%. I would be happy to own the second one, not the first one.
Correct.
The first one, growth is not sustainable. Dilution has to happen. And in case of, let's say, if dilution is required in bad times, then we can have a obstruction in compounding, right? So that's two aspects of quality for us. Number two, we want to have scalable businesses because growth is important in determining how much you can compound. And for growing businesses, we need two factors again. One, scalable business model. Two, capability of the management to capture the growth opportunity. So sector might be growing, but the inherent structure of the company and the management should be to capture that growth opportunity and grow profitably.
Sure.
Because that is where you create value. So
Absolutely.
to give you a perspective, the construction business in last 20 years might have been created highest amount of revenue potential in India. What we call is EPC business, right? All these. But stocks have not done great. Because when the balance sheet was not enough strong, ROEs were not high, management was not capable. So they went through their ups and downs.
Revenue streams,
management,
of course.
Yeah. And balance sheet went for a toss. So it's not just the opportunity size that has to be large. The management should be capable enough to capture that opportunity and create a profitable growth. So in growth, we look at these two factors, right? And the third thing is valuation. So as I discussed, business may compound, your portfolio still may not compound.
Sure.
And that is driven by valuation. So we want to have all these three factors driving our investment decisions. For large caps, we use a top-down approach where we look at first sectors based on earning upgrade and downgrade cycle. Because in large caps, it becomes very, very important. What you can preempt is earning cycle. You cannot preempt materially the multiple cycle.
True.
So the multiple derating or re-rating part, which is driven by earning cycle, is predictable. But in large caps also, there are also contextual environment where multiples get derated, re-rated. So that we cannot preempt, right? So we try to focus more on earning upgrade, downgrade cycle and try to churn our portfolio accordingly in terms of sectors. Once we have decided on the sectors, then we go to stocks, select stocks. In the mid and small cap side, we do bottom up.
Okay.
Because it is more, so of course there is a top-down thought process, right? If sector is doing well, there is an opportunity, so those mid and small cap can do well. But generally that is not a very long-lasting kind of a strategy in mid and small cap. Give you perspective, in 2015-16, chemical was a hot sector, right? And everybody just thought that for next 10 years, 15 years, this is going to be sector. But then again, very few companies were able to create significant amount of wealth for investors.
Sure.
Right. So in small and mid cap, you have to look at bottom up and then try to understand the risk and reward potential depending on the capability, depending on the business opportunity. So there we use bottom up approach, stock specific approach. We are more sensitive to valuation and churn in upgrade downgrade cycle in large caps relative to mid and small caps.
Sure.
So in large caps, there is nothing for us like buy and hold. We are happy to sell every stock that we own. We are happy to buy every stock that we have selected in our universe. And in mid and small cap, we are slightly more buy and hold kind of strategy. So that's broadly what we are going to do. And we think that that can have a differentiating impact on our performance.
Wonderful. Well, that's very well explained about your entire investment strategy, because that would have been my next question. And so how many schemes of equity funds you already have, Anupam?
So as you know, we acquired India Bulls Mutual Fund.
That's right.
Last year in May 2023. So we inherited from them 4 schemes. One large cap fund, one value fund, ELSS fund, and an aggressive hybrid fund.
Sure.
So along with building the team in last 1 year, 1.5 years, we have been trying to improve performance of all those schemes.
Right. Could you also throw some highlight about your equity team size, the bench strength currently?
Yeah. So we are in the process of building a team. And now we are confident that we can do this product. So we have launched this product. So we already have a team of 5 analysts. 2 more will join in December. So we'll have 7 analysts. We are in the process of hiring 2 more. We have 2 dealers and I am there as a fund manager. In next 3 to 6 months, we will have 1 more fund manager and then we will look for another product.
Sure. So how much do you rely on the sell side reports? And of course, how much do you rely on, going to the company, the shop floor level, while analyzing, a sector or a particular stock or a company? Just a very quick thoughts on that.
Yeah. So we use all possible source of information and data.
Okay.
There is nothing that we say, no, we will not look at it. Right. Sell side is also a very great repository of knowledge and a lot of experience in terms of tracking companies, etc. So we use them.
Okay.
We also use our own internal thought process, internal research, and whatever data that we can access. We have access to all the advanced tools like Bloomberg, Ace Equity, etc. And we also we also subscribe to a lot of international journals, periodical, etc. to have access to a much more global kind of perspective. Other than that, we keep on doing company meetings. We keep on going to, as you said, shop floors. So, burning the tires is a very important strategy.
Absolutely, yeah.
So, because that gives you, especially in mid and small cap, it is very important to have a first-hand understanding of business, vision, execution capability of promoters and companies.
Absolutely.
We continuously do plant visit, etc. So all possible sources of information that we try to use.
Wonderful. So Anupam, we are having this in conversation in very interesting times when the market is really corrected, as we all are witnessing. So very crisply, if you could just tell our viewers about your market views, let's say for about 1 year, 2 year period. And do you believe this FII selling, is it really hammering so much because of the strength of the DIIs available today?
Yep. See, in every trade, there is a buyer and seller, right? So the intensity matters. So of course, because all this is happening closer to December, a lot of hedge funds close their books. So of course, the intensity on their part is pretty high.
Yes, they do.
And because I think DIs can preempt it, so their intensity is not that high. Because they can assess that, okay, I can get it at a lower price, right? So that's an intelligent thing to do. So that's okay. But I think we should not look, I always believed in cause and effect, right?
Sorry to interrupt, but there's also a thought which comes to our mind that we are giving these FIIs a good, reasonable price to exit because of the DIs buying out on the other side, right? So is that right in your mind? Is it correct in your thoughts?
See, everything is right and wrong in a context,
Hmm.
correct? So what happens if, let's say, 10 years down the line, you think that all these stock prices are much higher, 5 years down the line, all these stock prices are much higher. And then you start thinking, oh, we could get a great opportunity to buy it from the FIs, right? Somebody has to supply the stock, right? Or somebody to buy. Or maybe if you look at post-COVID, DIs were selling, right? Heavy sellers. And FIs were sellers, heavy sellers, and DIs were buying, right? And 4 year, 5 year down the line, you feel good about it, that we can own so much of Indian stocks. Imagine if FIs were not selling at that point of time, then what would have happened? Sure. So I think it's all contextual, that who is selling, who is buying, who is proven right or wrong. The future will tell us that what happens. But I think so. Rather than analyzing flows, we should try to understand underlying causes of flows. So if your economy is doing well, if you are growing, if our companies are reasonably growing, flows will come, right? Just think of it. If I give you 1 crore, whether you will buy a land, and you can only buy land, whether you will buy land in Bihar or Gujarat.
Of course. We all know the answer.
Correct. Now, you look at what happened in China, right? And so China is not an economy problem. China is more of a governance problem. Chinese economy has been, of course, it has going through a downturn.
Yes.
Right. So to rely on something like that and imagine that somebody can actually put more and more money into it is a very, very difficult thing to believe. Right? We have seen people just simply disappearing, large, big companies, CEOs, owners, right? How much trust you will have in that system?
Yeah, winners rotate, as we say.
Correct. So at the same time, if we are offering a credible proposition to any investor, be it domestic or foreign, of companies doing well, economy doing well, a well-governed country, right? I think people will keep on coming to India and investing.
Sure.
And in between, it will happen, right? That people will sell some part of it. And if you look at from that perspective, foreigners own roughly more than $750 billion, right? Close to $800 billion.
Yeah.
That value changes depending on market.
Of course.
But whatever they have sold is hardly 2% of it. And we also know that in India, in some cases, valuation were ahead of the fundamentals.
They were.
Right. So I think that kind of caused trigger for readjustment of the market. So it may time correct for a while, maybe next 3 to 6 months. And I think once our earning kind of, and I would be happy to explain how I think the earning cycle part of it. I think once again, the market will start doing well.
Sure.
So on the earning cycle, I think we need to understand you segregate market in 3 parts, right? Overall, like economic participants. One, export oriented. Number 2, domestic B2B, right? Which is more led with capex, infrastructure spending, right? And the third part is consumption, which has 2 subparts: premium consumption or discretionary consumption, and the staple consumption or the basic level of consumption, right? Now analyze all these 3 separately, what's happening in them. So on export front, we export more services than goods, right? Especially the manufactured goods. If you like remove oil, a part of it, which is like just processing, our services exports are much higher. And that went through a pain point because of apprehensions of US companies about recession. Now everything is kind of settled in US. Election is settled. Recession is not happening, is settled. Fed is very confident that they will be able to control the managing the economy with rate cuts, etc. So I think that problem is now bottoming out. And it will also percolate towards the manufacturing side of it, where story is just starting up, right?
Definitely.
So I think in the mass scale of manufacturing, we cannot compete with China. But on the niche, customized, precision, high-tech manufacturing, we will do a better job. And that is where actually we are looking at opportunities, etc. And that will play out. That activity is happening. We are seeing hectic activity happening on the ground. So that's I think is bottom out. It will start showing you good results in next 12 months, hence from here. The second part is on the domestic side, right? B2B or the CapEx infra-led investing. CapEx and infra-led businesses. So because now in overall spending in India in terms of B2B businesses, government is now larger than private sector. Right. So for example, last year, total government spending on infra, etc., just the central government, if you add state governments, it would become much larger, was close to 9.5 lakh crore. Private capex was 9 lakh crore. And for every year, if you add state governments, now government will become a larger chunk.
Definitely.
Right. Because of election, we had a slowdown in terms of government spending. So that has got impacted. I think in next 3 months, it will once again pick up steam.
So,
and next year would be pretty good for that. There would be some undershoot this year, but from next year, once again, we will start seeing good growth.
sure.
Post Lok Sabha election, there were two major more elections, Haryana, Maharashtra, that also kind of impacted this. The second thing is that rains were severe this year. And most of the government spending is somewhere related to construction.
Yeah.
So that doesn't happen. Right. So that's one reason on the B2B and CapEx side. Now coming to consumption side. So consumption, there are two parts. Discretionary or the premium consumption. And the second part is your staple consumption. So on the discretionary consumption, we are seeing good growth across the board. I don't think there is some base effect could be possible for some companies, but almost everywhere we are seeing good growth in premium consumption happening.
Sure.
In fact, in some companies like automotive, etc., on the premium side, we are seeing major capacity constraint. So demand is there, but companies are not able to supply because they have capacity constraint. But on the staple side, we are seeing not so good growth on the listed space. And we have to kind of understand this, that the problem is what we are seeing is only in listed space. Actually, if you look at unlisted space, it's not that growth is not happening. Growth is there. But we are not able to kind of see it because they are not companies are not listed, etc.
Sure.
And there are two reasons why it has happened. One, because of inflation, most of the branded players have increased prices quite high in last 3-4 years. And that has kind of motivated people to downtrade.
Sure.
So a lot of smaller brands on what we call is unorganized players, etc. They are no more unorganized. They are selling on digital platform, etc. So they are doing very well. So I think the staple consumption part that we are saying slowdown, we need to take it with a pinch of salt. Not necessarily a slowdown. It's more impact of competition that some part of listed entities are getting impacted.
Sure.
So broadly there also, I'm not worried because consumption is happening. It's just that where we need to benefit. And that is why even in our investment strategy, we are more attuned towards premium consumption. On the B2B side or CapEx side, I think this is a good opportunity. Stocks have corrected reasonably well, like from 15-20% to even 40%.
Yeah.
I think it is good time because this spending will come back. And as government spends, private sector will also have to spend to create capacity and all that.
Absolutely.
On the export front, as I said, I think pain has bottomed out. And now as US economy start stabilizing and psychological stabilizing, it was already doing well, right? It's not that it was not doing well, but there was always apprehension of slowdown, etc., recession and all that. And Europe has also bottomed out because of war, etc. 2 years, it has gone through a big pain. And I think that has been also kind of now doing good. So all across the fund, all across the three sectors, I think broad areas, I think except consumption, which is the staple consumption, I think situation looks to be good.
Wonderful, wonderful. That was very, very well explained, Anupam. So, Anupam, through this in conversation today, what message would you like to give to the distributors, the RIAs, the advisors, the investors about Groww Mutual Fund and about your NFO of the Groww Multi-Cap Fund?
So on the multi-cap fund, we would like to request all of them to support us, recommend it to or work with their clients, understand with us what we are trying to do. We believe that we can do a good job. And from the Groww Mutual Fund side, I think we are a group which is very, very sensitive towards creating customer satisfaction. For us, it is like what we call is Groww code. Customer first approach, that we have. So for us, benefit of customer, his beneficial interest is much bigger than our own beneficial interest, right? So I think we can be a very, very good partner for them, for all the MFDs, for all the distributors, and we would be very committed partner, and we would be very reliable partner in future for them. And we hope that we can all grow together and create value proposition for each other. So from that perspective, I would invite them and request them to join us in our journey of creating one of the best AMCs in India in next 10-12 years.
Wonderful. That's really wonderful. So, well, for our viewers, this is Mr. Anupam Tiwari, Head of Equities with Groww Mutual Fund, talking about the investment strategy at Groww Mutual Fund, what he believes of the market, and those are very, very valuable inputs. And also, of course, about the new fund offer of Groww Mutual Fund, Groww Multi-Cap Fund, which is being launched on 26th of November and closing on 10th of December. So Anupam, thank you very much for taking out time to have this conversation and taking us through your thoughts and about the multi-cap NFO as well. Wish you the very, very best.
Thank you, Suren. Thanks for inviting me here. Thank you.
Our pleasure. Thank you.